Sea Limited, boy, you and I have a checkered past. For those who are unfamiliar, Sea Limited operates in Southeast Asia, thus the sea, and has a whole bunch of businesses. Has an e-commerce business, has a payments business, fintech, and it also has a gaming business through its hit game Free Fire. And this storied checkered past is playing out today as the company reports earnings. Now, I sold my shares back at the end of 2022, beginning of 2023, and it's about at the same levels where it was back then. But in August of 2023, I came out with a tweet that kind of went viral about everything that was wrong with Sea Limited. And about 6 months later, I started to realize, well, it looks like they might be turning the ship again. So the question is, at least as far as I'm concerned, where does the company stand today? And why should you care? Well, my name is Brian Stoffel. I've been a financial analyst for over 10 years. I've written over 4,000 articles for The Motley Fool, and I keep track of my results, which you can see in the blue line here since the end of 2014 versus the NASDAQ Composite and the S&P 500. I want to give a shout out to FinChat.io for sponsoring today's video. It's also an important video because it's worth hearing investors say, I might have been wrong about this. And that might be the case with Sea Limited. Let's investigate. This was the company's first quarter of 2024. It's about a $36 billion company today. On the top line, revenue was up 23%, which beat Wall Street's estimates. Bottom line came in just ahead of Wall Street's estimates on a non-GAAP basis as well. Now, margins weren't pretty, but it can be explained when you see how the revenue mix was changing. Gross margins were down significantly, as were operating margins, as were net margins. Free cash flow dipped, but not by a ton, and net income went from positive to negative. Now, you might be wondering, why is free cash flow so much higher than net income? Well, stock-based compensation is definitely part of it, but the other part of it that's worth noting is that Sea Money, the company's fintech arm, has started reserving cash for bad debts, and that's something that we've seen happen with Mercado Libre as well. When you do that, you hope that they never have to accept those bad debts. If they do, then that cash is already set aside, but they haven't lost that money yet. Thus, the huge delta, that and stock-based compensation between these two figures. Balance sheet in very strong position with about 8.6 billion in cash, 2.9 billion in debt. Let's just work down the income statement before we dig in a little bit more. First, revenue up 23%. You see that there. Unfortunately, the cost of that revenue is up 46%. That's not good. That's why those margins came down. So that's why gross profit, although revenue was up 23%, gross profit was only up 10%. If we go all the way to the bottom, operating expenses were only up 15%, and that's good because 15% operating expenses growth on 23% revenue growth, that's good. But let's break that down a little bit more. You see, general administrative, provision for credit losses, and R&D were all down with the 23% gain in revenue. That's great. But we got to pay attention to this right here, sales and marketing. Because as you'll see in a minute, Shopee, which is the company's e-commerce division, is where most of the sales and marketing expenses went. And it pretty much doubled from last year. And so the question becomes, while the gross merchandise volume, while the revenue that Shopee got, its growth was impressive, does it need this incredible increase in sales and marketing to get that type of growth? Because if it does, that's not sustainable. That's not a moat. But if it doesn't, if this is just Sea Limited returning to a baseline of normal sales and marketing spending, and it can still capture that growth moving forward, well, then there is something of the moat. This is something that might be investable. So operating income overall was down 43%, mostly because of those gross profit declines, and that's why net income swung from a gain to a loss. Now, let's dig in a little bit more by going to FinChat.io, a tool that I use every day. Now, you can use this tool for free by hitting the link in the show notes below. If you want to subscribe, you can get 15% off the full functionality, which you'll see right here. And when I go to FinChat.io, I type in the ticker symbol, and this right here is my favorite tab, Segments and KPIs. It's already been updated, even though the company just reported a few hours ago. And what I want to show you to start off with is these are the three lines of business, and this is where the revenue comes from, okay? This top one, that's Shopee. That's e-commerce. Think like Amazon. This orange one is C Money. That's their financial services product. Think kind of like PayPal. If you follow Mercado Libre, kind of like Mercado Pago. And this bottom one is digital entertainment, basically gaming revenue that comes from their hit game Free Fire. So think, Activision Blizzard before it was acquired, or EA, or Electronic Arts, any of those others. So it's kind of like this three-headed monster, and this is where all of that revenue is coming in. All right, so you see that, and then you might wonder, well, okay, so how much are each of these growing? So let's start out by looking at e-commerce. So e-commerce, what's important to see here is the e-commerce, the growth has re-accelerated. It was 16% growth before, it's up to 33%. Now there's two levers that we've got to watch that could be being pulled that might make this look stronger than it is. The first lever is that increase in sales and marketing spend, which isn't bad if it's not increasing by so much every quarter moving forward. The other is increasing the fees for the merchants that sell on Shopee. So we're going to have to watch this to see if it makes sense that it would start increasing right here. What we have to see is whether or not that can be at least sustained, or these growth rates can stay in the same ballpark and don't drop off. Now, if we go to the company's digital financial services, it grew 21%. I think that's perfectly fine. It had sky high growth when it was just getting started. Just the credit loss provisions are what we really need to watch. And we saw that its reserves for those credit losses fell during the current quarter. So that's good news. And digital entertainment. Now, it's not great to see that this is all negative right here. It was growing at 45% and then it went negative. But bookings are actually a better way to look into how the business is doing. And so we'll look at that in just a minute. All right. Now, I showed you over here, this is where all of the revenue comes from on the top line, revenue. What about operating income? Well, when it gets to operating income, for most of the company's history, gaming, Free Fire provided the operating income. It still provides some operating income, but for the longest time, Shopee and C Money were losers. They ate up money. Now that switched in December 2022 when the company slashed its sales and marketing budget by enormous proportions. It decided to shift gears again in September and start reinvesting in Shopee. What's nice to see is that C Money has still been a operating profit positive over this time, and those losses for Shopee are narrowing. So altogether, this looks pretty good. Couple other things to see. This right here is online bookings. Now, bookings are important because this is where a gaming user is going to pay money, but they haven't used it yet. But C Limited has already collected that money. So, I mean, even though they haven't recognized it as revenue, it's as good as money in the bank. The important thing to point out here is you see that it is actually going up ever so slightly. That is incredibly important. We see things improving across the board when it comes to that, because this right here are quarterly active users. And we see that it went up both sequentially and from the same time last year. And if we look at quarterly paying users, went up sequentially. It's at 49 million, and it also went up from 37 million the same time last year. So it looks like one of these three is really turning the corner in gaming. Now, here, we're going to get to one of the reasons that I decided to actually sell the stock. This is the company's gross merchandise volume for Shopee. Gross merchandise volume just means the value of all the stuff that was sold on Shopee during a quarter. And this is in billions of dollars, and you can see it increasing. But look at the x-axis right here. Tell me if you notice something a little weird. Here's December 2022. Here's September 2023. Where did March go? Where did June go? The company decided to stop reporting gross merchandise volume for 2 quarters, which was one of the key reasons that I had wanted nothing to do with Shopee, because when you remove that, boy, that makes me wonder about, does this company actually have a moat? They're removing one of the most important metrics for me and my investing thesis. Well, they returned to it here. And so it's kind of hard to draw one-on-one comparisons. We don't have a March 2023 figure to compare it to. Now, it did go up sequentially, which is nice to see because usually the fourth quarter is a strong quarter, and we've seen it fall in the first quarter, so that's good. We see that over a 2-year basis, it grew pretty nicely, so that's good. I'm glad that they're reporting again. It's very frustrating that they took 2 quarters off from doing that. The other thing that we can just see is the total number of orders. Again, this is something that they discontinued for 2 quarters, but it is good to see that the total number of orders on Shopee moved forward. So all in all, the gaming is seeing itself come back. See Money seems to be doing well, but we have to watch those credit loss provisions. And it looks like Shopee is going to start having operating profit. And the big question just becomes, can it continue growing without having to increase its sales and marketing? Can it continue growing and still have a take rate for Shopee that doesn't have merchants leaving the platform because they feel like they're paying too much? Those are the things that we have to watch. Now, the company doesn't give guidance on a quarterly basis. For the full year, Wall Street's expecting 14% growth. Management affirmed their guidance. The two key pieces to me is that they believe gross merchandise volume will be growing in the high teens, and Free Fire will be growing some of its key metrics in the double-digit range. So, what am I going to watch moving forward? Because this ship is starting to turn, and being able to get back in now at about the same price that I got out of the company about 18 months ago, but in my opinion, a much more well positioned, healthy, focused on building its mode out type company. Boy, it seems like it might be worth looking into for me. I'll be watching gross merchandise volume first. Second, I want to watch sales and marketing spend because that I need to know that they don't have to increase it so much to squeeze out growth for gross merchandise volume. If they do, what it means to me is they haven't built that infrastructure for delivery that beats all the other competition in the area, including what could be competition from TikTok and Lazada, which is backed by Alibaba. Building out that infrastructure is vitally important. Having a network effect where merchants and their customers can meet in one place is critically important. And if the only reason it's going up is sales and marketing, I don't want any piece of it. But if they have that infrastructure in place and that network effect in place, then that looks interesting to me. So it's the kind of thing where I would be willing to dip my toe back in with a small position and monitor it over time. Number 3, going to watch Garena bookings because that's been a nice boost for the company. And 4 is free cash flow. Overall, I think that the mode is stable, maybe increasing. As you can tell from the way that I'm talking about it, I'm cautious about this. I think that the company has gotten religion on building out a moat and not going after low quality revenue. But it's still tough for me to see whether or not that's the case, whether or not that's what's going on. Now, the next question becomes, what about valuation? Well, for that, we can head back to FinChat and look at a couple different metrics. Now, we could look at the company's PE ratio, but that doesn't really tell us anything because on a GAAP basis, it's all over the place. So PE ratio of 250, that really doesn't tell us anything. What if we look at it on a forward PE ratio, trading for about 40 times forward earnings? That's lower. It seems reasonable-ish, but not super low. Price to free cash flow, well, this looks more reasonable, 20 times free cash flow, but it is worth stating that on a forward basis, price to free cash flow is at about 40. Remember, those credit loss provisions are a big part of it. So paradoxically, if the company improves its lending, then its net income is going to go up, but its free cash flow is actually going to go it won't be as different than net income as it is right now. It won't necessarily go down. So those are some of the metrics to value the company by. They're not terribly satisfying. Another way that we could look at it is use a reverse discounted cash flow analysis. So for this, you have to put in the company's ticker symbol, that's SE. Then you need to put in its trailing free cash flow. So the company has $1,775,000,000 in free cash flow over the trailing 12 months. If we say that the terminal growth rate for this company is about 2%, and it's about a 10% a normal risk, well, then it needs to grow its free cash flow by, well, we got to make these two numbers match. How much is it? 12%, 11%, 10%, about 10% moving forward. Now, one thing that's worth noting is that this company's free cash flow and net income, as I've already stated, can be wildly divergent. And so it might actually be more instructive to just put the company's net income in there as well, because those numbers can be so different. Either way, 10% free cash flow growth seems pretty reasonable. Well, what do analysts think that this company is going to grow by moving forward? Well, guess what? FinChat has that as well. So I can go on here and I can go on analysis and estimates, and I can click on free cash flow right here. And what we can see is that we don't have the 2023 numbers, but we know that it's at 1.175 right now. Now, the consensus is that this is actually going to fall quite dramatically and be still at about 1.7775 billion in 2 years. Well, that doesn't seem like a ton of growth, but it's worth stating that there is a wide divergence here, where all the way up here it's 3.2 billion, all the way down here it's 800 million. So these are the moving pieces that are at play with Sea Limited. It's a tough one to value, especially because you've got three different businesses. If you believe the company has a moat now with the network effect and with its low cost production of being vertically integrated for shipping, well, then it seems like a really good deal now. But if you believe that most of this Shopee growth is mostly just from sales and marketing increasing, then it's not so much a good deal. What am I going to do? I'm going to spend the next week trying to figure out if I should be adding this to my portfolio. Let me know in the show notes below what you think of the quarter. And as I said, this is a great example of a case where I might have been wrong about the company, or at least its direction. We'll check back in on this one in 90 days when it reports. Until then, Brian.